Good afternoon, everyone. My name is Sri Kumar. I'm the CEO for India and Senior Vice President of the Global East for Indiaspora, based out of Delhi. Thank you for joining us on this virtual panel, the session named Capital That Lasts. As the name suggests, this conversation will delve into growth, importance, and evolving opportunities and challenges of family offices, primarily focused on India. A warm welcome to all the guests from different time zones, and I'm glad that you could join us and hope you will enjoy this discussion. Before we begin, I'd like to briefly introduce Indiaspora. We are a global convening platform that brings together leaders from across the Indian diaspora with a mission of organizing this community as a force for good. Our work is rooted in four pillars: entrepreneurship and innovation, civic and social engagement, global connect, and philanthropy. Throughout today's discussion, we aim to spotlight a theme deeply relevant to India's overall growth story, that of family offices and the ways in which we are reshaping capital, governance, and legacy. We sincerely hope you find the conversations both insightful and inspiring. Now I'm going to hand it over to the panel, and it's my pleasure to introduce Neil Borate. He heads the personal finance team at the FinPrint, a financial content platform. Neil began writing about personal finance in 2016 and joined Mint in 2019, and eventually became editor for the personal finance in 2024. And he was also co-authored the book The Big Bull of the Dalal Street on Rakesh Jhunjhunwala, one of India's most successful investors. Quickly to come to the panel, we have got Bhairavi Shibulal, who is the co-founder and family principal of Ekara Global. Bhairavi also leads the Shibulal family philanthropic initiatives, driving impactful work in education, science, and social innovation. Sharad Mendon, who is founder of the Legacy Custodians. He brings over 25 years of experience in wealth management, advising business families on governance, legacy, and purpose-driven capital. We have got Dr. Nishith Desai, founder of Nishith Desai Associates, and esteemed Indiaspora member. He's also a pioneering the legal strategist and thought leader in international taxation, asset management, and impactful investment. And lastly, Naghma Mulla, CEO and director of EdelGive Foundation. She's championed collaborative philanthropy and built one of India's leading platforms for social impacts. Again, thank you for joining all the dear panelists and the participants. Neil, let me hand it over to you and take this forward. Thank you so much.
Sri Kumar sir, and thank you everyone for joining us today. I will begin by talking about the very subject of this panel, of this discussion. And for that, I will turn to Sharad. So, Sharad, if you could define for us what is patient capital and how does one even define long-term capital?
Firstly, good afternoon, good morning, everyone from different time zones. Thank you to Indiaspora for the opportunity and to be amidst this elite panel. Also, Neil, congratulations to you on your entrepreneurial journey through FinePrint. We hope and wish you continue the fine work you have done over the years. So, best wishes to you. Diving to your question, Neil, we would define patient capital as capital without any expiry date. It is aligned with purpose, vision, and continuity, and ideally would straddle across generations. It would carry higher EQ versus just IQ, high on IQ, AQ. One of the defining traits of patient capital, in my view, is patience before investing and not just after. It is about evaluating alignment with purpose, ethos, governance, and looking at the longevity of the relationship. In most cases, it's also about waiting for the right price if I were to kind of only focus on investing, because price is the only controllable in any investment. Everything else is a variable over time. With most family offices, there are segregated pools, high performance pool, a debt pool, there is a purpose pool. In our view, patient capital cuts across both performance and purpose pool, which is different for very different families. But the real challenge is to achieving convergence between the two. Historically, business owners and investors buying businesses were very patient with their capital. Exit was not a popular concept then, whether secondary or primary. Today, with product platforms dominating, most capital allocations is limited to a trade. Even relatively long-term allocation, as they call it, often comes with pre-decided exit timelines. That is not patient capital in our view. It's just a long trade waiting to unwind. I think the most evolved investors recognize that reinvestment risk is bigger than most known risks in the investing journey of most investors. Reinvestment leads to increased decision making, which in turn increases the probability of mistakes. So long term, Neil, is not defined in our view by a time window. It is defined by a reduced reinvestment mindset, which is very critical and not often acknowledged in this rat race of participating and generating outcomes. In conversations with portfolio managers, public and private, over the years, we have often heard about rigor some of the global pension funds and endowments apply in their evaluations and the time they take to observe behavior alongside performance. What they are seeking is long-term alignment before committing. That to our mind is patient capital. There is never rush. That does not mean patient capital cannot be an opportunistic one. It can be. But not all institutional capital is patient. Many have defined allocations, not defined purpose. So to sum up, I would say every long-term capital is not patient capital. If we were to kind of draw a parallel, Neil, it's a classic comparison between cricket is in the air, so I can't resist talking about it. Cricket is it's a classic comparison between test matches and all other shorter formats of cricket, where everyone wants to see action and result in 3 hours compared to 5 days. The rules of game may not have changed much, but I think the game is completely different today. Patient capital is now trying to find its way through the maze of multiple rounds of funding. I'm not sure whether receivers of patient capital are patient enough, or if they want just capital enough to last till the next round. So what we have seen over the past few decades, it's a very different paradigm that we are witnessing now. I'm a firm believer in mean reversion, and patient capital will have its time back in glory sooner than we expect. I'll pause there, Neil, and if you have any further follow-up question, maybe I'll address. Did I answer your?
You did, Sharad, and I think it's especially important when so much of thinking is dominated by the daily fluctuations of the stock market, where we are thinking minute to minute, forget months or years. And especially when you think of how family offices can be patient in ways that individuals often struggle to be, I think that's a differentiator which many of us can aspire to actually follow. So let me bring in Bhairavi on that note. Bhairavi, if you can establish for us how family offices function, why one should establish one, and the value it can bring.
Sure. Thanks, Neil, and thank you everyone for the invitation to join this panel. It's a pleasure to be here. When I think back on our journey, Neil, in terms of building our own family office, there were largely, I would say, two considerations that we had at play. One is, of course, we recognized that there were growing complexities, right, in all of our very important matters, be it long-term estate planning, be it, cross-border taxation, be it, a way to sort of professionalize our investment mandates and our investment strategies. So these were growing complexities for us. On the other hand, as a group, we have multiple operating companies across diverse sectors. So we recognized that it was important for us to sort of set up a standalone platform that would manage these very important considerations for us over the long term. And since we established our family office, we've, of course, had the opportunity to interact with others in the ecosystem, other family office principals and things like that. And I think what stands out to me is there are a few key reasons why many families like ours choose to set up family offices in the first place. First and foremost, I think there is tremendous consolidation that a formal structure can bring, right? Because there is a sort of consolidation of your overall investment strategy. Perhaps there's a consolidation of tax matters as well, be it bringing various stakeholders who are important into the conversation. There's also a tremendous opportunity to streamline more day-to-day operational matters, such as treasury management and things like that. So that is, a key reason that many people cite as a reason for setting up their family office. I think also very importantly, many families, including ours, are very concerned about the sort of legacy that they are building in the long term. And they're building these structures to sort of, by design, be multi-generational in nature, right? So I think that's very important to recognize. We certainly see our family office as a vehicle for, allowing us to uphold our family values and our vision, and hopefully, be a stable foundation for generations to come. And I think many family offices operate in this way as well. Ultimately, I think family offices help you create a blueprint to preserve your legacy and ensure that in the long term, there is a smooth transition of assets, smooth transition of control and leadership, and various other things. It provides a sort of professional way to do a lot of these things. I think there is something to be said about optimization, because a platform like a family office can help investors or family office principals as investors reduce costs, for example, enhance their efficiency, perhaps even enable better access to various service providers in the ecosystem. So there is that angle as well. I think very importantly for many family offices is the governance framework, right? There's an emphasis on creating a robust governance framework. And I think that is very, very important to enable clear decision-making in the long term. And having a formal structure forces you to think of these frameworks from the get-go, be it creating a family constitution or perhaps an IPS or even a giving plan or a philanthropic charter or what have you. I think creating this governance framework is very important in setting up a family office. I think, of course, there is, a need to kind of be more private and in terms of the matters of the family. But I think also one has to balance privacy with also building in sort of transparency as well where it matters, specifically in terms of the regulators, reporting requirements and things like that. So yes, certain matters do have to remain private and confidential with the family, but then one also has to build trust and credibility in the long term. I think perhaps another, key reason is really a customized kind of approach, because no family is alike in terms of their overall long-term goals, their risk appetite, preferences, etc. So having a formal family office allows you again to design a tailor-made investment philosophy that is unique to you and your family. And of course, many of us do look to trusted advisors to help us craft these strategies from the get-go. So I think those are some of the reasons that, we've heard, from other family principals, and certainly our reasons as well for setting up family offices. But I will say, in closing that I really think, the era of a one-size-fits-all kind of family office is over, to be honest. I think there are many models at play. A family office, the beauty of having a family office is that it can really be whatever the family principals want it to be and kind of plug any gaps that are relevant in their unique context. And I think, some families, for example, they choose to set up, have appoint, like, for example, a CIO or hire, analysts and build in-house investing capabilities. Others don't want to directly or actively oversee their investment portfolio, but prefer to work with a multifamily office or other providers to kind of guide them on those aspects. And then there are families like ours, for example, who choose kind of a more hybrid approach. So if there's, people who are thinking about setting up a family office, I think it's very important to first figure out what the goals of the family principals are and work backwards from there.
Bhairavi, could you touch upon some of the typical structures used by family offices to the extent that is practical? Is it usually multiple structures, or is it like one primary trust? And then I'll just go to Nishith sir on this for more detail.
Yeah, I mean, I think it's difficult to kind of again have a blanket response to that, to be honest, Neil, because I think it's so important to understand that particular family's context. Context could be, their place of residence, the taxation norms across jurisdictions, their citizenships, and things like that, and eventually their long-term estate planning goals. So, for example, some families that have a presence across multiple geographies choose to create, trusts. That's a very normal, structure for movement of assets, especially if the intention is to create assets for the next generation to inherit and things like that. But I think it's difficult to kind of say that there is one definitive structure out there that would suit everybody.
Sure. Nishith sir, if I could bring you in on this, in terms of the
Sure.
investment vehicles that, if you could give us a couple of scenarios, maybe an Indian family office versus somebody in the US or Singapore, how would that planning change?
Okay, let me step back for a moment. And I think the subject for discussion is capital at last. If I could extend, the most important thing in the capital at last is capital that lasts with happiness. Number one, I think do not forget the role of philosophy. When we talk of structure, it comes at a little lower level. Why? Because everything starts with philosophy. What's the philosophy of the family? Like corporate philosophy, every chairman's statement, if you see annual statement, it's a corporate philosophy so and so. Very little discussion is, of course, happening on that. But law is also, for example, what is law? Law is a philosophy that is codified. Religion is a philosophy that is ritualized. We are more focused on rituals and codifications, right? We forget about, otherwise fundamentals are very similar. So same way, when you think of a structure, before the structure, you must have your strategy in place. Strategy precedes structure, not follows. Structure follows strategy. Like in architectural language, they say form follows function, not the otherwise. Okay, but before strategy is decided, strategy is all about choices to do this or to do this. How do you make choices in life? It's because of philosophy. So it starts with philosophy. From that emerges your vision, mission, goals, then structure, then strategy, then structure. So that is the hierarchy of the. So what is the philosophy of the family? Okay, that is something that you need to. It's a mix of art and a science. Because what is the purpose? Why do you want capital to last? Fundamental question is that just lasting capital and you can make a lot of money, but continuously leave unhappiness behind. I find 80 to 90% of Indian families leave behind disputes, disgruntledness, unhappiness, and keep on fighting for generations together. I think this is something every patriarch, every matriarch wants to avoid. But result is that the purpose of doing all these things is that capital that lasts and people do not have disputes and disgruntledness as much as possible. So that is how we have to really think. You can make investments, which is science, I would call, right? How much to allocate here, there, etc., which can last for a long time, which is fine. But how will that be used? That is the purpose of capital that lasts. Now, when it comes to structure, in fact, one of the things I'll do, I'll have my office send you a presentation which I made to, I think, Chartered Accountants Association some time ago on global estate planning and wealth planning. A little, so that you might just want to distribute if you want to. And today, two things I see. One, Indian families have become more professional, institutionalized slowly. They're learning the game. Best way is what is the the way to have the capital that lasts, right, is to have a value system. Okay. One, and the value is different from price. Let me put it this way. People mix up between price and value. Value is a function of perception. It's a function. It's perception. Price is a function of demand and supply. Now, when you look at all these products and other things that are coming up, one side is scientific, that you want to preserve capital from economic perspective. That is very important. So you make balanced investment and whatever risk you can take, it's up to you. I'm not an expert on, allocations and stuff like that. But as I said, there is scientific game. Second side is the legal structure that should be, such that the families are capable of handling. Whenever we look at any structure, we have something called LCMM model. So legal capability maturity model. How mature a family or an organization is to handle those complications. You can have a great trust, you can have everything, but you create so many complications. So when there are no disputes, you'll have more disputes because they've made a complication, right? So there are situations. Just look at how your children, your family members are capable of handling complications. Otherwise, have simpler structures. I think that would be better. So you have to see that. Third, your structure may be legally compliant, but no longer that is enough today. And I think you heard a lot about subjectivity and car-like situations coming up for tax purposes. So it may be compliant, but at the same time, it can cause a problem if you do not understand the spirit behind the compliance. So we have to combine both now. That's why it becomes art and a science. And every time you do a document, make sure that you recite a story a little bit as to why are you doing what you're doing. Otherwise, after 5 years, when GAR issues are raised, your kids or family may not even remember, why did we do this, right? So any even board meeting, when you pass a resolution, write a little good story as to why are you doing this, okay? That will allow you to stand the scrutiny of law, that this was the reason. It was just not avoidance of evasion of tax, right? It was something else as well. So that is very important from tax perspective. Similarly, in India, we have exchange FEMA, which was originally foreign exchange control. Now again, we are back to control days, then more management days, right? Unfortunately, otherwise. And we have to bear in mind that it is sometimes written so vaguely that, you have to be very, very careful and mindful. And so again, how capable are you to handle those situations? That is very important to know.
Right,
Third,
right.
the institutionalization of your family. I think I've gone too long. I'll stop here. But I think somebody told me to stop, so I thought I've gone too long. But there are a
Not at
number
all,
of
sir.
factors that one
Yeah.
can look at. We can continue to discuss. I'll stop here for a minute. But you have any question, anything else, feel free to ask.
Yes. We've actually had a request from the audience for the presentation, so hopefully we can share that after this session, the one that you referred to. In fact, we'll come back to you in the audience questions, but before that, Bhairavi, if I could come back to you for a minute.
Sorry.
Sure.
Sorry, Bhairavi, can you hear me?
Yes, I
Bhairavi,
can.
okay, sir.
Yeah. If you could contrast family offices with other kinds of investors in how they function and their outlook.
Sure. I mean, I think that's a good question. I think, if we zoom out a little bit, right? Historically, family offices have definitely differed from other investors, and their contribution to sort of the India growth story has also been, kind of significant for that reason because of these differences in approach. I think, ultimately family offices differ from other types of institutional investors because of maybe four key reasons. First and foremost, source of capital. I think also investment horizon is different than other types of institutional investors. I think definitely there is an emphasis on governance, and which perhaps I'll kind of talk a little bit more about as well. And I think finally, underlying motivation or the core motivation for doing what they do, right? And Mr. Nishith kind of alluded to the importance of knowing why you're doing what you're doing, right? So I think that is sort of a very different as an outlook or a philosophy, right, from other types of institutional investors. I think drilling down a little bit, right? First coming to investment horizon. So obviously, family offices, I think, and this is well established, they undoubtedly provide patient capital, right? And Sharad talked about this as well earlier. To the startup ecosystem, yes, but to other companies that they invest in as well, their own businesses, etc. I think unlike traditional venture capital or private equity investors that operate on fixed fund cycles typically, right? Family offices are not constrained by external LPs usually. So they're able to provide a longer runway, which is required, especially in disruptive technologies or new age sectors and things like that, where inherently the gestation is a bit longer, right? So I think family offices can play a very important role there to achieve, longer term growth. Not to say that private equity and venture capital is not needed. I think they're crucial for injecting scale, first of all, but also, speed of ramp up and things like that can only come from those types of capital. But I think,
Sorry,
family
Bhairavi,
offices provide.
just a quick interjection. So,
Sorry.
if you had to contrast the typical time horizon of a venture capital fund versus a family office being an angel investor,
Sure.
could you give us some timelines or how does it differ?
Sure. I mean, I think, typically fixed fund cycles are well established. There is, maybe a 10-year horizon that, most funds operate under 10+2 sometimes. I think for family offices, sometimes it's multi-decade as an investment horizon, right? And if they take conviction bets on key areas that are of interest, key companies that they're interested in, they typically, hold for a longer period of time, and they are partners, true partners in the journey, and therefore I think they're also seen as more founder friendly sometimes because they're able to bring in this stable foundation. They're able to stay invested for the longer period. Typically, family offices are founded by people who have had a successful liquidity event themselves or an exit themselves. They're successful entrepreneurs with a proven track record. So for their companies that they invest in for their portfolio, they typically would want to help them leverage that wider network or leverage their own expertise. And they would be very willing to open their networks for them. So I think in those senses also they're different from, it's about being a partner, as I said, a true partner in the truest sense of the term, in the long term. So I think, that's one of the ways that they're different. I think risk appetite, of course, is different because family offices can be a bit more tolerant of risk. Many of them, as you rightly said, are angel investors. They participate at early stages of investing, which is we all know this is the riskiest sometimes form of investment, right? But I think family offices know that, this is something that they're willing to kind of play the game because they either understand that sector very well because of their own experience, or they're, willing to stay invested and be patient in the longer term. I think also, governance, I spoke about this earlier, because family offices are typically founded by people who have built successful businesses. They typically emphasize, professionalization, having a robust governance framework in the underlying portfolio company also. And I think that's very important. And especially for like longer term growth, that's very important. And I think that is a key distinction in terms of outlook when they come in as an investor. I think, also in terms of motivation, right? Like core motivation, and this is very interesting, perhaps, and perhaps unique only to family offices. I think family offices typically make investments which are more in line with that family's values and principles, right? So that would see them allocate more towards ESG initiatives or impact investments, or even, of course, philanthropy and things like that. But their core motivations behind which they make their investment decisions are guided by, various other factors. And of course, financial return is one of them, but it's not the only reason. So I think those are some ways by which, family offices tend to operate a little bit differently. I hope I've answered your question.
Oh, absolutely. Absolutely. I'm going to quickly jump to philanthropic capital. And I think let's bring in Nishith sir first because he has another call to attend. So, sir, if you can tell us a little bit about the vehicles that family offices can use if they are more focused on philanthropy.
Yeah, I think philanthropy is the most important thing that one needs to, because most of the time we focus on commercial returns and other kind of stuff. But how do you manage philanthropy? There are 2 or 3 points I would make. One is that, where to spend money has to be clearly understood. A lot of people would leave money for philanthropy. Now, there are even experts in the world who tell you how to spend your money, right? For example, I heard that Bill Gates, for example, he wanted to put $100 million in Haiti. Now, their perception was that it is the sanitation where most monies are needed. But when they studied, they found immediate need was for ambulances where people died more. The priority is, it is like you are all business people, you think customer needs X, but his needs may be Y. Same way, you think people need this, but people need something else. So it would be, for large philanthropy, it is very important where do you deploy, or that is one part of the game. Secondly, as far as structures are concerned, one is the Indian structure, and number two, the international global structure. Do you want to go global and do global philanthropy? Because after doing something for India, you may always want to do something else elsewhere because you made money in another country, and you may have like empathy for countries like Africa and whatever it is. Because we have to look beyond India now. Time has come to do that. So the way in which I would look at it, for India, there are two structures I see. One is not-for-profit structure. It is more difficult in India to manage not-for-profit structure in lighter vein, don't get me wrong, but it's more complicated than for-profit structure. For-profit structure does not compel you to make profit, So more and more people are now going and giving up tax exemption because they want more freedom to do what they want to do. And if you spend away money for the purpose for which is formed, you may not pay tax. So tax could be if you spend money, and when you spend money, you'll never run short of money. Mr. Balkiwala, who was my mentor, and MR Pai, and we used to work those days together. If they set a forum of free enterprise, and they say we must spend away the money. If you spend money, they never run short of money. So there are philosophical issues. I'm not suggesting one way or the other is right or wrong. So this is one aspect. Second, global philanthropy, when you look at, where do you set up? There are a number of good jurisdictions, but one thing is that you may have to have a structure where there is domestic structure, but then the global pooling, say Switzerland is one of the good places, or other places, there are 2-3 places in the world. So they are neutral, they are long-term, and like Red Cross and other ones have all been there, right? So this jurisdictional issue is very important. On one hand, the donors need to take direction for the contribution made to not-for-profit. So they have to contribute to domestic structure. But then further thing is pulled up in the international global structure. So now we have to think of those kind of things. Third thing, I would say that, um, managing this philanthropy is also very, very important part of the game. So how and who are going to do that? And those who manage philanthropy, often they are not valued in the family enough. So again, when you write your documents, I think you have to provide enough cushion for people, because when they dedicate their life for society from whom we have made our money, okay, we are not valuing them enough. So there is another feature that I would suggest. And today time is not enough. I'll be happy to take hour and a half long session on all these kind of subjects. But it's very important where to set up philanthropy, where the monies are coming from, what kind of course, deductions are coming up, tax deductions. In India, we have exchange controls and stuff like that, but there are still ways to go about it. So it is important that philanthropy is giving back the money where it came from, and
Absolutely, sir.
but in terms of structure, as I said, do not be obsessed by tax. I am myself a tax lawyer, but I said it is important to do tax planning and other things, but do not be obsessed. Otherwise, so the tax lawyers and accountants, conversation starts with tax and ends with tax. I don't want to do that. I would suggest that purpose is more important, strategy is more important, philosophy is more important. Are you achieving your philosophy or the strategic objectives? That is what you see in the structure. Otherwise, you'll just have structure upon structure, and you'll only manage structure rather than philanthropy. I'll stop here for a minute because I think others have a lot more to contribute, and
Wise
my
word, Nishith
apologies
Bhai.
that I
Thank
have
you.
got. Yeah, thank you. And
Thank
I
you,
think
Nishit, sir.
my colleague has circulated a small presentation to, I think, everybody. It's been circulated. Okay, yeah. So you can take a look at it, and anytime you have anything, most welcome. It deals more with structuring the global wealth and estate planning and those kind of things. Okay. Appreciate your inviting me. Thank you very much, Indiaspora, Neil, Sharad, and Bhairavi, Naghma. All of you have been wonderful to be with. I'm so delighted and excited, but thanks a lot for giving me this opportunity.
Thank you, sir.
Thank you.
On that note, let me
Thank
bring
you.
in Naghma since we are on the topic of philanthropy. Um, Naghma, if you can elaborate on how to maximize the impact of philanthropic capital.
Okay, thank you. Thank you very much for having me here. I'm very delighted that philanthropy is at least part of the common capital conversation, because usually philanthropy is approached as an extra that we have to think of once we have arrived at a certain income level or a certain wealth level, and then how do we give back to society? And I have a primary, disregard for that kind of an approach. The fact is that India, and if I still look at India, India out of the 1.4 billion people has not more than 800,000 millionaires, not more than 400 billionaires. So that's the inequity that we are operating out of. The fact also is most of the people who are philanthropists are giving in small numbers and are giving. There's a lot of spray and pray, and then there is an expectation that lives will change. That kind of capital has never changed anything in investment. How can it change in human welfare? So whatever has been said by Bhairavi, by Sharad, by even Nishith sir, it applies to philanthropy as well. There has to be patience, there has to be a good structure, there has to be basic fundamentals and principles and visions and missions on how you want to give. But what the one thing that is absent universally, but now more in India, and I'm not going after Indian philanthropists. I'm just saying the global West has been doing this for much longer, so they've learned from some mistakes. We are at the beginning of the journey. The thing is, simply because we are from India does not mean we know the problems of the poor in India. Our lived experience of growing up and what is happening to the poor in India today is vastly different. It was a different experience being poor in the 50s and the 60s and the 80s and the 90s and now in the 2020s. And therefore, when we give, there has to be a certain amount of understanding that we will have to lean into a structure. And then look at how are we giving. We want to give exactly to change that life, to feed that human, to educate that child. Just like any good industry, even the philanthropic and development industry, it needs investment to make capacities work, to make governance works, to ensure that the last mile is reached. The way philanthropic capital is currently operating in India is largely either to give exactly where it's needed, which means that the entire pipeline of servicing is underinvested. There is no staff, there is no capacity of that level that you want change to happen. Okay. Second is there are a significant number of philanthropists who will start their own foundations because the popular image is that NGOs cannot be trusted. And I have a very, very strong reaction to that because a trusted ecosystem can only become trusted when you invest in it, when you invest in its people and its systems, its ability to report back to you. We don't pay for legal fees, we don't pay for capacities, we don't pay for admin. We think admin cost is a bad word in philanthropy. And if unless we fix these presumptions that come simply because we have no experience of real time poverty and what it takes to get a poor person to get even reasonably fed in a day, okay, the way we give cannot improve. So the reason why I'm sounding like this and also listing down these things is it's not that difficult. When in the startup world, or when you have a new idea which is unproven and there's this one person who's coming with this great idea and conviction, we don't fund them and ask them how many bus tickets have you taken and how many flights are you taking and are you yeah, what is your admin cost. You give it some time to develop. You stand by that startup idea so that it comes to a mature level, and then you're also having an appetite to say I put my money in 10 startups and maybe two will be my will work out well. I mean, there is nothing unique about what needs to be done in while we are giving in philanthropy. So why is it then so different? And at the risk of again sounding really brusque about this, it is different because we somehow seem to believe that because money solves human problems. Money does not solve human problems. Empathetic capital ensures some part of this distress is bridged. And so, first, philanthropy is everywhere in the world and now in India as well have to understand that they cannot solve the problem. They're assisting in bridging some part of the problem. Second is the patience has to be never ending. If you had some patience in business, you have to have much more patience here. And third is you have to fund for capacity, or you have to let go of judging how things are being delivered. Because on shoestring budgets, to expect lives change in under 2 months, and children getting full marks in maths and science, and women being violence free, and farmers being able to grow crops of their choice on a shoestring budget that does not provide for any reporting, any technology, any HR, doesn't work. So I would like to pause here.
Fair point, Naghma. We have only 5 minutes left for the moderated part of this session, so I'm going to go finally back to Sharad. Sharad, we can talk about the rise of the alternate asset management industry, and how does it complement family offices, or how does the approach contrast with them? If you could shed some light on that.
Neil, as in, this has always puzzled me as to why do we call it alternate asset management. This is a primary funding source for businesses and ideas that public markets seemingly do not cater to anymore. Public markets are largely about rewarding or penalizing shareholders. In fact, it's now been looked upon as an exit route, contrary to what we have seen over decades, right? They are not designed to support the business itself. In contrast, private capital has the potential to be patient, to be strategic, and to build something very meaningful. Yet it is labeled alternate. I attribute that to the influence of the West, because like many industries, we have been influenced by the West in terms of how funds are structured, how risk is managed, and even how fees are charged. The famous 220 model. That model works very well for global investors who prefer a familiar territory to operate and allocate. After all, if you look at the Indian alternates industry, have been dominated by global LPs, limited partners as they call it. The contributions from domestic family offices and institutions have been on the rise though, but it's relatively limited compared to what we've seen from global allocators. Having said that, I think over the last decade and a half, the alternate asset management industry has grown rapidly. It has definitely brought a very professional approach, structure, access, and a lot of sophistication. But it also comes with a very different mindset, Neil. Most of the capital in that space is designed to enter and exit. The investment is often structured with a timeline, as I said earlier, and a return expectation and a clear exit route from day one. So I look at that as a long trade. I keep going back to that, and it's very different from patient capital. Bhairavi alluded to decadal or multi-decadal allocations that family offices look at, which is why most domestic family offices are now beginning to recognize this. They are seeing that many fund structures do not align with their objectives anymore. And especially when it comes to deploying patient capital with purpose. You are seeing the growth of impact investing, but that's a very small subject that is being addressed. And even they are taking, because of lack of response maybe in the marketplace, they are also kind of trying to position themselves as impact, which can also generate significant outcomes. That's why we are seeing increasingly single family offices building their own approach. Some are choosing to compete with alternate funds. Others are co-investing alongside them, but the common thread is clarity about what they want to do with the capital. At our end, Neil, our role is to help families find that clarity. We help them to separate product from strategy, as Nishith also alluded to, because strategy is very different from product. People interchangeably use it because in practice, we often see both of them being interchangeably used. Product is just a means to end, and I think this entire thing about alternates asset management is overdone. It is not a strategy. Strategy is what matters. Each family has its own purpose. Their objective is unique, and the capital must reflect that. In fact, in our own journey, Neil, as entrepreneurs now, our understanding and appreciation of risk and capital has evolved significantly. It's very different from how we saw it as when we were employees back then, right? That shift has shaped how we work with families, We are building a team of entrepreneurs who understand capital not just as a resource, but as a responsibility. So a long way to go, but I think there is a lot of structure that we see. One trend that we are seeing, Neil, is this allocation through a structured approach is also leading to a lot of stress that is developing in the ecosystem, because you have seen funds who have been in existence for about 7, 8, 10 years finding difficult to exit. Then you see continuation funds, opportunities fund. Now there is a very large breed of secondaries that are coming in. These are all mechanisms to provide exits, because strategic exits are strategic M&As are not happening. IPO is, of course, you are seeing the buzz around IPOs, but IPOs become an exit route. But with stress building up, I think it's anyone's guess how this will play out over time. But I think it's exciting times for the industry. I hope it ends well.
It's a very interesting point, Sharad, and I hope we can do another session on exactly what is happening with private equity, with secondaries, etc. But that said, given the limitation of time today, I think we can head to audience questions. So perhaps we can start by, since audience members have given specific speakers specific questions, so we can just go speaker by speaker so that it's evenly distributed. So Shenya, would you like to highlight the first one for Bhairavi, or you want me to read it out?
No, you go ahead.
Okay, just give me a minute. I have to open the. In the meantime, if you can, to save time, please do. Meantime, I'll just open the list.
Okay.
The
So
other
Bhairavi,
thing,
the question. Sorry, go
the other
ahead.
point, Neil, just I wanted to conclude on the family office bit. Single family offices, wherever we have seen family principals taking a back seat and operate as an institution, they are now increasingly operating like a fund themselves and no longer have the color of a family office, because family office, the original objective of family office has now been taken over by institutionalized approach in the process. And what Bhairav indicated on the involvement of family office is paramount to have a color of family office outcomes.
Okay, great. Should I go ahead, Neil, or do you have the questions?
Yes, I've opened the list. Okay, Bhairavi, so the first question is to you, which is about internationalization of family offices. Is that a key consideration when you think of creating one? And what support do families look for when they are internationalizing their existence?
Sure. I mean, thanks. That's a good question. First of all, I think diversification. At the end of the day, is on every family's minds, right? But I think what diversification means can vary from family to family, right? And there's no one right way to do things. I think, of course, for some families, they want to have a presence in other geographies as well, and there are mechanisms to do that. But if one is going down that approach, I think, compliance with the regulatory norms is paramount importance, right? And I think that it involves like a very deep study of what those frameworks look like before then deciding if one wants to set up a presence there. But I think also, diversification could look different. You don't have to have a presence in various geographies to get access to opportunities. I think, Sharad talked about this a little bit earlier on in the discussion when he said that, you could invest in perhaps Indian companies that have offshore revenue sources. That's a form of diversification, right? So I think there's no one right way to do things. I think it's very important, as Mr. Nishith also said, to figure out your underlying motivation or your why. Like, why are you doing what you're doing as a family principle, right? Is there some other element here? Like, obviously, for some families who are looking to expatriate, then perhaps it makes sense to have a formal established structure in some jurisdiction. But if it's just about diversification, I think there are many ways to achieve that goal.
Okay, there is one follow-up that's related. I don't know if you want to take it, but perhaps you could answer it in more general terms. So this is about family offices moving based from India to say UAE or Singapore. Is the legal system in India not conducive to their growth? So perhaps a more sort of wider canvas that should you think of other countries as bases also?
I mean, how much time do we have? Right? Like, I think this is a very long conversation, and we could go on forever. I will say that I'm not an expert on this matter. Perhaps Mr. Nishith is better equipped to answer this one, but unfortunately, he had to leave. But I think, for many families, it's very important to establish a base if there is some contextual reason as to why that is required. I wouldn't say that it is absolutely essential for everybody. I think it's really dependent on the specific family, their comfort with that jurisdiction. So many families have ties to, the UAE or to Singapore or some other, geography. And I think it's important to study that as well before deciding on which approach to take. But I don't think there's one size that fits everybody. I don't think there's one approach that one can be prescriptive about. I think it's very, very personal as a decision to each family.
Okay. Final one to you. What are the best practices that you've observed while preparing the next generation for family leadership?
Is that to me?
Yes.
Okay. Well, this is a difficult question for me specifically because I do count myself in that next generation cohort itself. I think I'm not there yet. Maybe ask me again in a few decades. But I think, overall it's about figuring out why we're doing what we're doing. I've already said this before. I think that will ensure that any family office sticks around in the long term. I think from previous generations, and we've been blessed in this regard, to have these very strong family values being passed down from generation to generation is very important, something that we would like to emphasize going forward as well. I think there is a significant emphasis on that. I think, also there is a need to equip, future generations with the necessary skill sets to do whatever it is that they want to do. And I think, ensuring that they are empowered sufficiently in that regard, they are able to take independent decisions also is important. Especially, creating structures that facilitate this in some way, so they can be independent decision makers for themselves. I think that's also important.
Okay. Sharad, would you like to take a stab at this? And I'll give you the related question to this, which is that how do family offices ensure that the investment decisions remain aligned with the family's core values across generations?
Yeah, I think we see that as a challenge and an opportunity as well, because most family offices are evolving in the sense of family office itself. Uh, uh, I think the beginning is moving conversations from dining table to boardrooms and having more formal conversations about the intent and the long-term objectives of families. We are seeing that across most families that we work with. At least the beginning is very positive, and there is an intent to move in that direction. Of course, it's a very long journey to document everything. Uh, we see families initiating conversations around family constitution and investment policy, being a part of all those kind of governance mechanisms. Of course, it's a challenge to implement that, and that is the key. But I think we are in the right direction as far as the awareness is concerned, with seniors like Nishith Bhai and many other firms out there who are engaged with families in various capacity. That awareness is also creeping into families to make that call now, because as we see, most families are custodians of their wealth and not consumers of wealth. For a long time, the industry uh, expected them to operate like consumers of wealth, and when we engaged families, we saw their portfolios behaving like any consumer of wealth, with over diversification, with no purpose, with no direction. I think that is all changing now. And as custodians of wealth, your decisions, your directions are very different than just a consumer of wealth. Yeah, I think a good beginning, Neil.
All right. Naghma, the next one is to you. That are you seeing a genuine emergence of purpose-driven wealth, or is it early days?
No, I do, for all the angst I have about, not enough philanthropic capital. There is, it is very unfair to say that there is no purpose to philanthropy in India, that the wealthy are not. We participate in the EdelGive philanthropy list also, and we see a lot of that moving. What I'm saying is it's not enough. It is also the early days. What we need right now is a conscious understanding that we do understand our country better, and therefore, our philanthropy needs to be rooted in our values, our empathy towards the people in our country. The tendency to spend like it has been spent in the past by players across the world. We have to learn the best, but also remember that the poor in our country have our own context. So I think that there is a rise of empathy, but I hope for more. It is early days, yes, but it's not insignificant. That's what I would like to stay with.
All right. The next one is not allocated to anyone, but anyone on the panel is free to take it, which is about the diaspora. So, are there any unique trends emerging from the Indian diaspora's family offices? Sharad, if you want to take a stab at that.
There is significant interest. I think even the government is promoting India in a big way, and the entire gift city structure has been created for increased participation. It's an irony that everyone's looking at gift city an uh, from an externalization of capital perspective, which could be very different from the government's objective of bringing in capital. But we are seeing significant interest, and of course there is awareness across the board, and I think one of the leading indicators is uh, many of these asset management companies now becoming uh, ready to accept those allocations from global investors into India. While Gift City may have come over, may have come into existence about 5-7 years ago, or maybe longer. I think we are seeing green shoots of foreign capital, offshore capital coming in to the diaspora. And some of the structures are very convenient for them to participate, and there are benefits that are being passed on to the global citizens.
Okay. There's a related question that's just popped up, and we might have to take this as the last one. Regulations specific to family offices, are they subject to the same ones as funds? So I think probably in the context of Gift City and OPI, etc.
Fam Funds operate with a very different approach, and the regulations governing funds could be very different than what could apply, because the family office approach is far more concentrated, family focused around family structures, and one would need to consult uh, their uh, their tax partners for structuring. But in my view, the industry operates through a very different mechanism and structure, and rightly so.
All right. So I think there's no more questions. We can conclude. Let me just thank everyone very quickly. Sharad, Naghma, Bhairavi, and of course Nishith sir. Thank you so much, and to our audience for being so engaged and asking a lot of questions to all of us here. I hope we were able to
Thank you.
deliver some value to you.
Thank you,
Thank
everyone.
you. Thank you so much, Neil.
Thank you so much. Thank you.